Welcome back to my channel. This is Stocky. Our today's topic is fundamental analysis and technical analysis. These both are like tools to approach the market. So who invented these terms? When was it first used? What exactly do these terms mean? How to implement these practically? We will see it shortly. Let's start with fundamental analysis. Who invented fundamental analysis? Benjamin Graham, the father of fundamental analysis, popularized the use of financial statements and ratios for competitive analysis of companies in 1928. By analyzing a company's financial ratios trend, you can assess its performance. Fundamental analysis uses historical and present data to forecast financial outcomes. Now let's see the objectives of fundamental analysis. 1. Stock valuation. Fundamental analysis aims to determine the fair value of a stock by evaluating its financial health and prospects. 2. Price predictions. It seeks to forecast future price movements based on a company's performance and economic factors. 3. Business performance projections. Fundamental analysis assesses a company's past and present data to make projections about its future business performance. 4. Evaluating management. It examines the competence and effectiveness of a company's management team in running the business. 5. Making internal decisions. Fundamental analysis helps in making internal business decisions, such as expansion plans or resource allocation. 6. Assessing credit risk. It involves analyzing a company's financial stability to assess its credit risk for lenders and investors. 7. Determining intrinsic value. Fundamental analysis aims to calculate the intrinsic value of a share, which is the true worth of a company's stock based on its underlying assets and earnings potential. Now moving to technical analysis. Who invented it? Technical analysis, as we know it today, originated from the Dow theory introduced by Charles Dow in the late 1800s. Other notable researchers like William P. Hamilton, Robert Rhea, Edson Gould, and John Magee further build on Dow theory, contributing to its foundation. Technical analysis primarily uses historical price and trading volume data to analyze and forecast financial outcomes. Objectives of technical analysis are: 1. Forecasting price movements. Technical analysis aims to predict the future price movements of various tradable instruments based on historical trading data. 2. Applicability to different securities. It can be applied to a wide range of securities, including stocks, futures, commodities, fixed income, currencies, and others. 3. Supply and demand analysis. Technical analysis is considered as the study of supply and demand forces reflected in market price movements. 4. Focus on short-term price movements. Traders often use technical analysis to analyze short-term price changes, especially in commodities and forex markets. 5. Beyond price. While primarily focusing on price changes, some analysts also track other factors like trading volume or open interest figures. So, in short, instead of focusing on a company's financial health and economic factors like fundamental analysis, technical analysis relies on studying price patterns, trends, and market indicators to make predictions about future price movements. Here is the difference between fundamental and technical analysis. 1. Fundamental analysis analyzes financial statements and economic factors, whereas technical analysis focuses on price and trading volume data. 2. Market may misprice securities in the short term for fundamental analysis. whereas all information is reflected in the security's price for technical analysis. 3. Fundamental analysis evaluates companies' financial health and prospects, and technical analysis examines trends and price chart patterns. 4. Fundamental analysis aims to determine the correct price of a security, and technical analysis predicts future price movements based on historical trends. 5. Fundamental analysis is usually best for long-term, and technical analysis is good to use for short to medium term. 6. Fundamental analysis focuses on the company's intrinsic value, and technical analysis emphasizes sentiment and investor behavior. Please note that this table is a simplified comparison between technical and fundamental analysis. Both methods have their strengths and weaknesses, and successful investors may use a combination of both approaches. Now, how to implement fundamental analysis practically. Implementing fundamental analysis practically involves a systematic approach to researching and evaluating the financial health and prospects of a company. Here are the steps to carry out fundamental analysis. 1. Research and data gathering. Collect relevant financial data and information about the company you want to analyze. This includes financial statements like balance sheet, income statement, cash flow statement, along with annual reports, SEC filings, industry reports, and news articles. 2. Understand business model. Gain a thorough understanding of the company's business model, products, services, target market, and competitive advantages. This knowledge is essential to assess the company's growth potential and competitive position. 3. Financial ratios and metrics. Calculate and analyze key financial ratios and metrics such as price to earnings, or P/E ratio, price to book, or P/B ratio, debt to equity ratio, return on equity, that is ROE, and others. These ratios provide insights into the company's financial performance and valuation. 4. Industry and market analysis. Evaluate the company's position within its industry and study industry trends. Understanding how the industry is performing can help assess the company's growth prospects and competitive landscape. 5. Management assessment. Evaluate the company's management team, their track record, and their strategic decisions. Look for transparency, competence, and alignment of interests with shareholders. 6. Future outlook and catalysts. Analyze the company's future prospects, growth opportunities, and potential catalysts that may impact its performance positively or negatively. 7. Valuation analysis. Estimate the company's intrinsic value using various valuation models like discounted cash flow, or DCF analysis, or comparable company analysis. Compare the intrinsic value to the current market price to assess whether the stock is undervalued or overvalued. 8. Risk assessment. Consider the risks associated with the company, such as industry risks, economic risks, regulatory risks, and management risks. 9. Make investment decisions. Based on the analysis, decide whether to buy, hold, or sell the company's stock or other securities. 10. Continuous monitoring. Continue to monitor the company's performance, financial statements, and relevant news regularly to stay informed about any changes that may affect your investment decision. Next, how to implement technical analysis practically. Implementing technical analysis practically involves a systematic approach to studying price, charts, market indicators, and trends to make informed trading decisions. Here's how to implement technical analysis. 1. Select the security. Choose a security like example, stock, currency, or commodity you want to analyze. Ensure it has historical price and volume data available for analysis. 2. Choose a time frame. Decide on the time frame you want to analyze, such as daily, weekly, or intraday charts. Different time frames provide different perspectives on price movements. 3. Study price charts. Analyze price charts using candlesticks or line charts to identify patterns, trends, support, and resistance levels. 4. Use technical indicators. Apply technical indicators like moving averages, relative strength index, that is RSI, and moving average convergence divergence, that is MECD, to gauge momentum and price strength. 5. Identify chart patterns. Look for chart patterns like head and shoulders, double tops, bottoms, and triangles, which can indicate potential trend reversals or continuations. 6. Follow trend lines. Draw trend lines to identify the direction of the prevailing trend and potential trend changes. 7. Evaluate volume. Analyze trading volume to confirm price movements and identify significant market interest. 8. Combine indicators. Use multiple indicators to cross-verify signals and increase the accuracy of your analysis. 9. Set entry and exit points based on your analysis. Determine entry and exit points for your trades to manage risk and potential profit. 10. Practice risk management. Implement proper risk management techniques, such as setting stop-loss orders to protect your capital. 11. Backtest and refine. Backtest your trading strategies on historical data to evaluate their performance and refine them as needed. 12. Stay updated. Continuously monitor the security's price movements and adjust your analysis accordingly. Remember, technical analysis or fundamental analysis is not foolproof, and no strategy guarantees success. It is essential to combine technical analysis or fundamental analysis with other forms of research and use it as a tool to support your trading decisions. Regular practice, experience, and discipline are key to becoming proficient in technical and fundamental analysis. That's about fundamental and technical analysis. Thank you for watching. See you next time with new topic. Till then, keep learning.